Good morning, Shiv. Thank you for joining us
James.
on the M&A Diaries. How are you today?
Very good. Weather helps, obviously. Well, it looks like it's going to
Yeah,
be a bit poorer for it over the weekend, but that's just sod's law, isn't it? So
yeah,
trying to enjoy it while we
absolutely.
can.
Yeah, absolutely. I got hit started with a hay fever this morning, but hopefully we'll get through the recording all
Yeah,
fine. I know it's
good.
been very, very busy times for you at TC Group as well. So, look, the reason why I wanted to get you on is you've got a great understanding and hold and grip of all the different models within the industry at the moment. And I guess that's part of the exciting time that we're seeing in the accounting industry at the moment, that there is loads of different models out there that can be tailored for the individual needs of the practitioners that you're talking to on the vendor side. Um, so for me, it would be great for people that don't know you, to give if you would mind giving a bit of an introduction on yourself, kind
Yeah.
of what TC Group's background as well, and then we can get into the wider market conversation.
Yeah, sure. So that's really helpful. Thanks, James. So I'm Shiv. I'm the director of M&A at TC Group. TC Group's got a bit of a potted history. So its background is very much a traditional accountancy and advisory practice. We used to be known as Taylor Cox, predominantly based in the South Coast. So we've gone through quite a fundamental change nearly 9 years ago, where we were run as a very traditional practice, but recognizing a lot of the limitations that traditional practices can face in particularly today's marketplace, where you've got an only more burdensome regulatory environment. There's clearly a lot of opportunities and challenges coming with tech and talent acquisition. And those were the same challenges we faced, and also a lot of drag on growth opportunity as well, where you've had partners not just focus on service delivery, but also having to run the business itself. So we took the decision internally at the time to really try to remove a lot of that burden from our partners. So rather than partners be focused on service delivery, but also have to spend their time running the business, be that managing HR, recruitment, marketing, IT, and tech investment, financial reporting, etc. We've taken that away, invested in a central services team and infrastructure over the course of 9 years now, to really allow our partners at a local level to focus on really what they enjoy doing, which is the service delivery. And I think a consequence of that has meant actually we've been able to grow and expand the group at pace. And certainly that's accelerated over the last few years because of the state of the market.
Yeah, I absolutely appreciate that. And Shiv, your particular position in TC Group, if you wouldn't mind just letting the guys listening in know.
Yeah, sure. So in my role as director of M&A, I'm primarily responsible for partnering with new firms to join the group. The way we operate is, on surface, on paper, we look like we're a large national firm, a single group, and we offer the capabilities that you can expect from a national firm. But what's fundamentally important is that we allow for local autonomy for practices within the group, allowing our partners to have a clear sense of ownership of the practice they've built to date, service delivery for their clients, but being able to access other services that other parts of our group can offer,
Yeah,
and really making sure there's an alignment of the efforts they're putting in and how they get incentivized and remunerated out of the earnings of that practice. So my job is very much, particularly in the backdrop we're facing in the market, is to engage with businesses who are exploring their options and hopefully finding a good, mutual fit with one another. And at the same time, whilst we're really keen to continue bringing in new firms into the group, it's really important that we're focusing on supporting our incumbent practices on their own growth strategies, and that includes their own acquisitions. And I think we offer a very unique proposition in that regard, where we can allow for smaller business owners, maybe sole partner firms, to realize capital value and exit their business and sell their practice to an equally like-minded local practice, providing a very local, dedicated service to their clients. So, broadly speaking, that's my remit. We're also looking at ways in which we can support our firms with respect of, bringing in other fee earning capabilities within their practice as well. So,
yeah.
definitely not keeping me quiet, and plenty of plenty to keep me busy and out of trouble for sure.
Yeah, no, appreciate that, Shiv, and we'll dive into the TC Group model slightly later on in the conversation. But I guess just to set the context for everyone listening in, as we know, there's the last 3 or 4 years, activity has just increased so much in terms of M&A perspective in the accounting practice industry. I thought last year was crazy busy. This year, it just seems like the pace has increased even more. And obviously, you've mentioned a lot of the dynamics at play when you was talking earlier on. In terms of lack of succession for a lot of practitioners out there, talent attraction, retention, keeping the pace with tech and AI. You mentioned that as well, and the increased regulatory admin that's coming on. But one of the major dynamics that I've seen quite a bit, and you've probably seen in your conversations, is the general dynamics at play in terms of age profile of the partners. A few years back, it probably was 3 or 4 people. They set up an accountancy practice together, and they go through their entire career in that format, and then retire together and pass on. Now we're seeing different dynamics at play where you might have 2 or 3 that are approaching retirement age, and those that are maybe 50 years of age, and others that are younger that want to drive the business forward. And as we know, that dynamic tends to cause a clashing of heads where the older partners are maybe thinking, well, I've only got a few years left. I want to maximize my profits out of the business. Whereas the younger partners are going, well, look, we need to reinvest to grow the business and evolve the business for the future. So, with private equity coming into the market, I think that's certainly helped answer and correct some of that dynamic at play. But yeah, have I covered most of the dynamics that you're seeing that really are driving the M&A activity in the market at the moment, or is there others that I hadn't mentioned there?
No, I think that is probably broadly it. I mean, what I would say is, there's always been a underlying current of transactions in the sector. It's probably
Of
not
course.
seen as much scrutiny until more recent times because of the volume of those, and perhaps even actually there's been some real notable practices that have gone down that route, and that continues more recently, right? With one of the big six, Grant Thornton, going down their own process. There's some not notable firms who have also announced that they're exploring their options, the likes of AAB and others that haven't been publicly announced, but through various conversations, I think there's an awareness that there'll be some more exits, if you like, coming up.
Of course.
So I do think a lot of what you mentioned there it has always underpinned, a succession event happening for a lot of these businesses, and I think that's going to continue. There's always going to be a challenge of partners wanting to realize value, but not necessarily having the pool of talent within the business to be able to pass it on to them. And I do think trying to facilitate internal succession has become increasingly difficult in a higher cost environment as well. So there's also, and the element of obviously, fundamentally the value you could achieve out of that would be less than if you were to go to an external party in today's market. And, I think as, other businesses are being, I guess, bought up by larger platforms and joining larger platforms, they are effectively able to tap into a much more competitive edge, perhaps, than their peers in respect of, when you join a consolidator, there's, they're all quite different to some degree, but the minimum expectations you can expect are, well, access to a range of resources which you'd otherwise not you'd struggle to replicate on your own, be that an access to a central marketing team for new opportunities, or HR to help with talent acquisition and retention. So really, there's clearly been some demonstrable evidence to suggest that actually that is value additive to these businesses, where the partners can just focus on service delivery. And a technology, I think, has been real kind of really at the forefront, I think, of everyone's minds. I think there's always been some sort of disruption from technology in the sector for as long as there've ever been accountants. But I think that pace of change has only accelerated, and I think it creates a lot of opportunity. But what you probably find is a lot of these businesses, the leaders aren't necessarily best placed to drive a lot of that change, because it's not something that they're particularly in tune with, and so actually trying to do that on your own, whilst the other alternative is actually maybe joining a group that can offer you that that specialism or capability, makes it perhaps slightly easier to think about doing something with a larger group. So I think you're completely right. I do think with the a level of activity happening last year, and there's clearly been price inflation over time. There's new private equity money coming into the sector, as we've seen from overseas in the US, where typically they're able to price deals at a higher multiple than their UK counterparts.
Yeah,
it
yeah,
is, that's just going to be driving, in my mind, more activity this year than last year. I think a lot of what we saw last year perhaps was an acceleration of processes. I don't know if you agree with that, because of the uncertainty of the macro environment and I guess the geopolitical environment, the uncertainty of what the new UK government would look like, and in anticipation of a Labour government, what that would mean for tax,
yeah. I mean,
a bit of a tax
CGT back in
environment.
October was a massive driver, wasn't it? Yeah,
Exactly, yeah. And, we then saw that even the first quarter of this year because of the announced changes to BADR in the October budget. So I think there's been an element of acceleration of activity, but I do think there's still going to be an overall higher volume of activity this year. And I think that's going to be because there's been so much that's happened already. There have been some notable primary exits in the sector. So the opportunity perhaps to join a group and then be able to benefit from that could become more appealing. There's certainly more certainty attached to that kind of value, as part of the overall value proposition. And as well, if you've got firms who are coming up to, I mean, consolidators that is coming up to their exits, expecting a level of multiple that, we've not, it's not, I don't think anything's been publicly announced, but there's been an awareness of what some of the primaries to date have gone for. That can perhaps allow them to perhaps stretch the pricing a bit when they're looking to acquire independents, with the expectation that they are going to benefit from some arbitrage as part of their own exit. So I do
yeah,
think that's
yeah.
going to drive volume, and also that will probably drive a bit of price inflation as well. So yeah, I think
Yeah,
you
no, I think,
generally covered it as well. I do think we're not going to see an increase in volume like next year or the year after. I do think we're going to see probably a bit of a plateau. I mean, that's going to be partly driven by scarcity, right? There's only going to be so many now businesses of a certain size that are going to be attractive for private equity to invest direct, or for there to be transformative acquisitions for PE-backed consolidators. But also, I do think there's inevitably going to be a bit of a fallout, from consolidation, just because of how disruptive it is to that traditional earnings and autonomy model, and as well, who knows really whether the firms who are considering their primary exits at the moment are going to achieve the same outcomes as their peers have to date, like the Cooper Parrys, the Danes of the world. And that, I think, is going to then perhaps drive a bit of uncertainty for independents considering their options as well.
yeah, no, you're absolutely right. I mean, I think a lot of people had the eyes on that Cooper Parry deal at the back end of last year, especially from the consolidator model, just going, please go well. Because if that goes smoothly, then those that were maybe a little bit uncertain or had reservations about joining a consolidator model because of that back end side, and then realise, okay, the financial benefit to that, for them if they roll some into top co or whatever it may well be. But no, I mean you're exactly right. I mean the succession part. Some I think there's a lot of generational change in terms of ownership versus leadership. So there's a lot of people coming through that maybe they move from business to business a little bit more freely than what they used to do. So that's certainly affecting. But then banks are not really helping as much as they used to as well in terms of buying into a partnership or buying into an accountancy practice. So there is that element of people having to look externally now, and certainly from the AI tech side, I would say the last 6 months that certainly moved up the order in terms of when I'm speaking to potential vendors and they're talking about their options, that worry about being left behind. By not being part of a larger infrastructure for sure. And it's interesting you made the point about maybe they're not best placed to lead that march. And, historically, accountants have just run the business, have done marketing, HR, whatever it may well be. Whereas, you look at any other SME business, usually they've got experts in those positions. It might be a marketing director, it might be a HR director. So now that the accountants are evolving and having those specialists at that top level, that really will help that growth, in all departments, including technology.
I agree. Yeah, I mean, I think there's definitely, obviously, independent practice of a size that have warranted investment in those individuals, that those kind of non-fee earner specialists in those areas, because you have to sort of consider that, right, to kind of sustain the size you are and also the growth plans that you have. I think it's a case of all firms will, as part of their growth journey, will come to a point where it's the sort of fork in the road. Do we start making those investments to try and establish a level of infrastructure that can support our growth plans, or is there an alternative that can not just achieve the same, but perhaps accelerate that and therefore create more value for us,
Yeah,
as a whole? And I think you're completely right. I do think over time, a lot of the requirements associated with even compliance, and just being on top of AML, or and kind of making sure that the quality of the work being done is up to scratch. That marketing HR, I think they've always probably been seen more as an administrative task, but actually they generally can be enablers if done the right way and if delivered the right way in terms of supporting growth strategy as well.
Yeah. So we've kind of discussed there the dynamics at play and what's driving the activity. And you obviously in your position as well as myself, we then want to move on to what are practitioners actually looking for then when they're having conversations with potential suitors. What are you finding that those practitioners are looking for to rectify some of those dynamics that are at play? I mean, for me, I've certainly seen a shift in the last, I'd say, 3 to 4 months, where it was more driven by maybe money and lack of succession and this worry about getting left behind. But actually, with the regulatory admin coming down, and as you mentioned there about the compliance type side of the running the practice, a lot of practitioners are now turning around to me, I don't want to do the heavy lifting. I'm not enjoying it anymore. This is not fun. I just want to go back to what I got into profession for, first of all, which was to look after my clients and develop a team behind me. That certainly moved up the ranks in terms of when people are talking to me, the reasons why they want to sell. Are you seeing that? And what else is other conversations you having?
Yeah, I think there's certainly an element of a degree of herd mentality as well. I think there's definitely an element of more engagement from independent practices with the likes of ourselves, my peers, and likes of you, I guess, and other introducers and facilitators in the market, because they know other firms have gone down that route. There's clearly been a sufficient precedent to make people think maybe this is something worth considering. So I definitely think there's been more engagement in that regard. I also agree with what you said there, in that actually, yes, there's always the point around, look, this an attractive time to consider my options. Who knows whether these current conditions will last, but I never see that, generally speaking, the overriding factor or the driver for when we meet with business owners. And I think that also talks to the DNA of an accountant, right? I think typically, historically, accountants have always, operated in the order of firm, client, and then self. So yes, there's obviously great opportunity to crystallize wealth for themselves, their family, and dependents. But actually, that's never really the overriding driver. It's usually the things you mentioned there around, I'm doing far too much, running the business that I don't really enjoy, and too little of the things that I do enjoy, and the reasons why I got into this profession in terms of service delivery. But I also think that the tension there, and I think we've certainly seen lead times perhaps take longer from the point of that initial engagement to when firms are committing to doing something and then committing with a party. I do think those lead times are longer because it's a really big decision to take, right? And I think you touched on it earlier. The partnerships we're seeing now are mixed in terms of demographics. They're not all of, you do have some who are predominantly all of a certain age, but actually you typically have a mixed age profile where they've clearly try to, what they've brought people through into the partnership, to facilitate succession over time. And you've clearly got that conflict of interest there. You've got opportunity, perhaps the ones that are going towards the end of their career to maximize capital value. But actually, what does it mean for the ones that are going to be carrying on in the business? And what does that future look for them? Because a lot of the time they would have gone into this role expecting to be able to continue having influence and autonomy running their business, the uncertainty of what that would mean for them joining a larger practice, and then the uncertainty of, well, they're currently being sponsored by a private equity house, and perhaps, yes, values seem to be aligned, but when they come to realize their investment, there'll be a new sponsor. What does that then mean for the
Absolutely.
overall
Yeah.
group in terms of how direction of travel they want to take it? So I'm definitely seeing that playing a part. And actually, in some cases, firms deciding, you know what, maybe it's not right for us to do something, especially when we're talking to consolidators whose sponsorship is likely to change in the next 12 to 18 months, because actually, who knows what that looks like.
Yeah.
So whilst I think there's a lot of engagement, still strong tailwinds for firms to want to join a larger group or to take private equity investment, do you think there's a lot in reverse that's also adding time to these decisions, and sometimes actually resulting in firms deciding not to go down that path and to carry on as they
Yeah.
are?
And I think I'm certainly seeing that divisiveness, if you want to call it that, more
Yeah.
more more recently, where people are like, are we going to go down the PE route, or are we going to just stay independent? And I'm certainly seeing that a lot more, and actually people's thoughts and position on that is becoming ever stronger as well in that independent camp, or are we going to go join this one of the larger consolidators or private equity backed platforms?
Yeah, what I would say is, and obviously I would say this because we're on this journey as well. I think there's definitely benefits and merits to consolidation. I mean, I can even talk to TC groups, background or heritage in the sense that typically speaking, and it's not to say this is the case with everyone, because I do think, irrespective of the topic of discussion today and what we're seeing in the market, there'll always be independent practices that remain in the sector, and they'll continue to thrive as independent practices. But generally
Absolutely.
speaking, that very traditional independent practice has never been well suited for medium to long term growth because of the fact that, particularly in today's age, where there's all those facts we mentioned before, that can result in a firm falling behind in terms of not being as competitive as their peers. But you've also got ultimately all the capital income, really in the hands of a group of individuals that, as they've obviously worked very hard, put all their efforts into the business, and they've clearly then built a lifestyle to, to kind of commensurate their efforts. And there's always going to be that tension of, okay, how much of that do we actually reinvest in the business? Now, we had that, in our own background. We had managing partners who were of an age where they had more than one eye on their own exit and all the kind of capital income rights in the business, but weren't making those investments into the business that were needed to allow the business to carry on its growth, and to really scale at that next level. So I think what private equity is recognized coming into this, because professional services as a sector, private equity have been probably quite late to that sector compared to others. But what they recognize is clearly a lot of value there that can be extracted and actually in part used to, invest in those businesses, to become more agile and actually, really scale for growth. And I think we certainly see the merits in that. But I do think there's an argument to say actually perhaps in the more traditional environment, perhaps that has left too little earnings that are left behind for those partners, because ultimately that's the real big variable here, isn't it? That anyone can really change. It's actually how much is left behind for the partners. And I think we've seen that, right? The earnings model has been significantly disrupted. Yes, there's been capital events to help kind of crystallize some of the future earnings there, but that has been fundamentally disrupted. And traditionally speaking, those individuals are then kind of moved on to employee fixed salary ceiling
Yep.
model roles going forwards. The hook for them is obviously part of a larger group, potentially holding equity in a top co, which can then realize value. So for all, drive forwards together in the same vein, we all benefit in kind.
Better
And I
work-life
think that's
balance.
that's valid to some degree, but obviously at some point the value of that equity in that topco is going to run out of road when new sponsors come on board, pay the multiples we're expecting them to pay, to then want to achieve a higher exit on their own, a higher multiple on their own exit. Um, so what I think, what we certainly have offered is actually that alternative of, look, you can get all the benefits of being part of a group, not having to worry or be burdened by the running of the business from a practice management perspective, get all the access to other capabilities that you aren't able to have yourself, which you're having to farm out to third parties, which really is value leakage or an opportunity for clients to then switch providers. But actually fundamentally entrusting those partners to, look, you've been doing this job for as long as you have, you're more than qualified to do that. You should still be able to do that to the best of your abilities and as you see fit. And actually your earnings, out of doing that should really be driven by the profits in that business as well. So I
Yeah.
do think there's certainly alternatives to what that consolidation could look like. And I do think if for those that haven't really addressed that future incentivization challenge for the younger partners who come along that journey and perhaps haven't been as significant beneficiaries of those capital events, I think if they haven't addressed that, that's going to become a problem down the track, that will need to be solved at some point.
Yeah, no, certainly that could alienate some people. And I think we are already seeing some of that in play now, where that younger generation is spinning out and setting up their own businesses and growing it around, which, as we know, is just going to be the cycle of the market anyway. It will happen.
Well, we've seen that
Which,
actually. I don't know if you saw recently, the top brass of EY and PwC have setting up
yes,
their own outfit, Unity Advisory, in June. So, and that's actually attracted US investment as well. So, I totally agree, and we've seen that along the way, as you mentioned there. 'Cause I think people are just striving for, greater autonomy, better economics, and there's a clearer sense of ownership. And I do think that's going to become, especially if you start seeing more of these being done and actually proven to be successful, I do think that's going to become an attraction as well.
Yeah. Well, look, on that note, let's dive into these models that are out there and
Yeah.
try to unpick them a little bit. So obviously, you've got the pure retirement model, which is usually 100% buyout. The retiring partner or partners will stay on for some time and help with some sort of transition to pass over those client relationships. We don't necessarily need to dive into that so much. That's pretty vanilla. And then you've kind of got what I call a salaried silo. So a firm that sells into a consolidator of some kind or a larger business. However, it's 100% acquisition. They don't have any equity. They become salary partners. There may be an element of bonus depending on the performance of their office. But essentially, the reason why I call it a salaried silo is because you're still independent in the sense of you're running that office just under another banner and you probably got integration behind you, but you're not necessarily um, having the autonomy and independence to make decisions yourself. So that's certainly, we know some of the players in the market that look at that kind of option. What's your thoughts on that particular model?
Yeah, I think it's interesting. I think it's definitely going to be suited for some firms, right? I mean, you've got those that, for instance, and I do think that the first one blends into this as well, bleeds into this to a degree because of that multi-partner practice with different age demographics. You're going to have some that are willing to go down that route because, quite frankly, they see themselves only really working for maybe 3 years, 2 to 3 years at most. That that would far better suit them than perhaps carrying on with the ownership risk and reward of having equity in their own business. And I think for the others, I think it really comes down to actually where they are in their journey and their circumstances. Are they fairly young in their careers, and therefore, actually, are they looking at this as an opportunity to progress within a larger business beyond just focusing on the responsibility of delivering the service they are in their portfolio? And I think you've got the cohort in the middle, if you like, who maybe, I don't want to necessarily put an age to this because I do think it's quite easy to think about people in those sort of binary terms. But,
Absolutely.
let's say they're sort of mid 40s to mid 50s, they're still got a long tenure ahead of them, generally speaking. Does that suit them? Yes, did they benefit massively from that capital event? Who knows? Does that environment suit them having gone through so many years of their career now, effectively being their own boss to a degree and having that autonomy and really being able to earn from what they deliver in the business? And I think that's, for me, it'll be interesting to see kind of how those individuals fare in that environment and actually what it is that they're being offered to support their ambitions.
Yeah, absolutely. And then the next one is quite similar to the salary silo, but for me, I call salary group. And I guess the big difference for me there is that all the heavy lifting that we were talking about, running the practice gets completely taken off. There's centralized services, but essentially you're still a salary partner. There may be some element of bonus in there as well to help with your remuneration. But I guess it speaks to those people that just want to go back to looking after their clients and their team. All the heavy lifting, centralized services is there. You're just in charge of your office, or you amalgamate with another office and just looking after your clients. So that for me speaks a little bit more to some of the dynamics that we're saying at play and what practitioners are looking for.
Yeah, I agree there. I think there's generally, unless somebody's got into this profession who's really just wants to run a business, I think generally speaking, these are individuals that want to provide service to their clients and they want more time to do that and not have to be burdened by everything else. So I agree. I think that's probably, as I say, the sort of minimum level of expectation a firm can have when they're considering their options of joining a larger group. I think fundamentally, all of the kind of consolidators or platforms will offer that as part of their proposition.
Yeah, no, absolutely. And then, for me, you've got the next, the roll up, which probably speaks to a lot of the market now in terms of those private equity backed platforms where they are offering to the key individuals some form of, whether it's 10 to 15%. I think on one of the deals that I was aware of is up to 20% of the consideration or value that they're getting for their business. They can roll up into top co. And as we were talking about, going on that next journey for however long that is, 3, 4, 5 years until the next capital event and roll again. Now, within that, there are lots of different nuances that I've seen. You've got some that maybe there is still an element of they run their office, maybe going back to the salary silo. model that we were talking about, where they still run the office, but a lot of the heavy lifting still sits with them. But there is integration in terms of probably financial reporting and whatnot that sits behind them, and certainly a different branding. And then there are others whereby it is a lot more full integration. You've got centralized services that you tap into. You maybe run the office or one of the seniors in the office, but obviously you're going on that journey, so you've got that equity and financial interest going forward.
Yeah, and I do think that's probably the main, I would say the main model I tend to see when we're talking to targets in terms of the options that they perhaps have on the table. If I think about the sort of the larger kind of platforms in our profession, I think that's the typical structure that they would offer, and I think that, particularly given you've got the sort of the events that have happened and the expectation events that are going to be happening, as I mentioned before, I think it's offered more certainty in people's minds of what it could be achieved by holding that equity in that top co. But it does feel like that is really the primary hook, if you like, in terms of bringing those individuals on the journey. And that, I think, is going to be the same lever that's used by the new sponsors that come on board in the absence of really, having that strong alignment between what people are owning and what they're expected to deliver in their own portfolio or office, or whatever their kind of sphere of influence is. Now, in terms of our model, we don't really sit in any of those buckets. There's certainly elements of that applies to us. The provision of those central services. We do integrate firms onto our kind of tech environment. There's conformity with regards to compliance and risk management. But for us, actually, is the ability to allow partners to have autonomy with running their portfolios and their offices. And I think what we really demonstrate is actually you can still have the benefits of being part of a group, but your earnings capacity doesn't have to be compromised, and your autonomy doesn't necessarily have to be compromised. And that's the key thing for me. Those have always been the two factors that have driven individuals to come into the profession and choose to go on that journey up to being a partner. And that's what's made independent practices thrive. And if you think about certainly the practices in our group, and if I think about the majority of the kind of consolidators in the market, we're all working with clients in the SME and managed business space in the main. You'll have obviously portfolios of large corporates and so on. We personally think, and I personally think in TC that to provide the best possible service to those clients, it's useful, and I think it's really important to have the same attributes as those clients. You're dealing with entrepreneurs, you're dealing with people that have risk in their business. Why is it that their advisors can't have that same sort of dynamic as well? And I do think ownership risk has been a real talking point. I think you're right. You mentioned before, there's certainly more individuals of this generation than their predecessors who would rather not take that ownership risk and perhaps prefer the employee model. But I do think ownership risk in a practice part of a larger group like ours is fundamentally different to ownership risk in a true independent practice, because of all those business decisions that don't quite frankly have to sit with you anymore. The decisions that we take on behalf of the group around tech adoption, investing in robotics or AI, shaping learning and development programs, support with talent retention. We work in collaboration with our partners to shape those because we want to ensure they're fit for purpose. But the decision and making and the investment need in those doesn't have to rest locally. And so really what the reward and risk comes to the service delivery and growing those portfolios, which I think hopefully should suit entrepreneurial and ambitious individuals. And I think whilst, as I say, there's more people of this generation that prefer the employee role, I don't think it's fair to say everybody's, cut from the same cloth. And actually, I do think you still have entrepreneurial and ambitious advisors who want to work with entrepreneurial and ambitious SMEs and owner-managed businesses as well.
Yeah, I couldn't agree more. I know often when we had these conversations, it's like a big sweeping statement or stereotypes that are out there. But, as we know, there still are a hell of a lot of entrepreneurial-minded individuals that want to take on that responsibility. And I guess just before we move on to the kind of the next model or the outliers, which TC Group, I would certainly sit in that pot. I think with the the salary silo, the salary group, and even the roll-up, one of the really important things that people need to be thinking about if they are looking at those types of models, even more so because of the not lack of, but there isn't that true autonomy and independence still, is that cultural alignment has got to be right to make that work. Otherwise, it's just going to fall out of bed. And that's, from your clients to your staff to your team and yourselves. So as much as there are small nuances from a financial structural point of view and the black and white of the deal, really, I think for those models that we spoke about already, is that cultural element. Are we on the same path, or if we're not at the moment, do we want to go on that path? As we know, there's some firms that quite haven't evolved with the times, and they might be drawn in a structure where they already are, years ahead. So they need to know that, okay, if we're not there, we definitely want to go on that journey with you. And I think that's, it's an element I talk about quite a lot when we're talking to vendors and acquirers, is that culture element gets lost quite a bit. And I think if you are doing that 100% sell and then you're taking equity at top co, or you can become a salary partner, you really, really need to focus in on that culture element.
I agree, yeah. And I do think it's really easy to get bogged down on the numbers and the economics as well. As much as I mentioned before, in the majority of cases, I don't see that being the first sort of reason people say as to why they're having exploring their options, but it also it fundamentally becomes such an important part of that decision, right? And as accountants, numbers just you gravitate to numbers, and therefore really can end up focusing on that. But I completely agree with you. Deals on paper may seem better than others, but actually longer term may prove to be less successful because of that. It wasn't ever that consideration of alignment of values between the kind of the firm coming in and the group in which they're joining. And I think that talks to, generally successful firms will, as long as they look after their people will look after their clients, and then the rest will take care of itself. I think
Yeah,
as long as the firm is built on those foundations, and there are some really, there are some firms out there, my sort of peers or competitors, if you like, who I think are doing great jobs in shaping, that kind of that value proposition around culture and
absolutely.
everything. And
Yeah,
I do think there's no shortage of options, for firms deciding to join a consolidator if that's the decision they've taken. But I think it's fundamental to ensure that there is that alignment of interest there for sure. I think where the uncertainty may come is just depending on their governance structure. Is obviously if they are sponsor backed, what does that mean when that sponsor realizes their investment and a new sponsor comes on board to the culture and ethos of that business? But I think if you're an intelligent investor and you've got something here that works, why would you want to change it? So there's an element of trusting that actually, yes, there's uncertainty, but fundamentally, these investors are coming in to make a return, yes, but not a quick cash grab, right? These are to be done over a period of time and over a number of years. So
yeah,
that should hopefully mitigate some risk in people's minds. I mean, you have
yeah,
some firms, and not just us included, but this does apply to us. But there are other firms like us where we have PE sponsorship, we are sponsor backed, but actually we've structured our governance structure so that if there is a change in capital structure and we get a new sponsor on board, there's no disruption to our group. There's no drag and tag. Everybody who signed up to us will benefit in the same way, or expect the same kind of services in return, the same economic and commercial relationship going forwards as well. And we're not alone. There's others who have a similar structure as well. So that can often again act as a nice differentiator, if you like,
and
for
that's an
people
important part.
considering
That's an
options.
important point you raised there, Shiv, because that comes up in conversations as well. People often do worry about, okay, what is it? It's fine this cycle, but what's the next cycle look like? And as you just outlined, there's protections that can be put in place. But I just
Yeah.
wanted to, before we do move on, I just wanted to pick up on that point where we talk about cultural alignment. And often when I'm speaking to vendors, and as we said, I always say to people, before you enter into a process, have an idea of that number in your mind that you want to get to, because the last thing you want is to get into a process and you've got two or three suitors that are speaking to you, and then you start to get blindsided by the numbers that are put in front, because often in the experience that I've had, the person that comes in with the highest valuation is not often the person that is going to be best suited for your business. And I've seen it so many times where people get blindsided by the larger valuation, go, great, we've got to sign a deal with them. And actually, that's fine on the initial element, on the completion, cash day one. But that deferred element, you might not realize that because your cultural alignment is so out of whack.
Yeah, I agree. And I think what hasn't helped, and this is definitely not how you operate, by the way, at
No,
Chambers
no.
Group, but what hasn't helped is because of how frothy the market is, there have now been a lot more brokers or introducers who have entered into the space, to facilitate these transactions. And I think there's definitely a cohort of those firms who just don't quite understand the economics of these deals. And they are quoting what are quite aggressive, pricing to elicit interest from sellers, and then in return are trying to build credibility with buyers by showing them a big book of potential opportunities for them to consider. But then there's this it's all been born or built on this sort of complete misconception or misalignment of expectation of what their business is worth. And unfortunately, you've got individuals who, these prospective sellers who have never done this before and are trusting
Yeah.
what they're being told by, a so-called expert, so to speak.
Yep.
And then you potentially have some acquirers because we've talked predominantly around sort of consolidators in the traditional sense, PE back consolidators, but there are independents who are also
Of course.
acquisitive at the moment.
Yeah.
And you'll have some who are perhaps going on to that journey who, again, haven't got a great level of insight in terms of what is the pricing that needs to be paid, for these types of businesses. And so you've potentially got sellers who have been sort of really kind of geared up to realize their option, being brought to market, and unfortunately are frustrated because they're not able to realize the value that's been put in their head. And unfortunately, they're not able to, realize the value of the business that they could have if they'd actually perhaps, had far better expectations. Or you've got the risk of, buyers thinking relatively immature buyers thinking, well, we should commit to these prices, but then struggle to execute that deal because they're not able to raise the funding for that deal, or
Yeah.
will not get the sign off from many of their existing funders potentially. So I think that's created some issues and some challenges. But as
Hugely.
I
I
say,
mean,
I think
you and I.
going back to your point though, about pricing is an important factor. But you're right. You need to think about all the risk factors attached to that pricing, the credibility of the acquirer. Are they able to actually fulfill execute a deal at that price? What are the conditions attached to the deal that is really linked to that future performance, and therefore is that an environment you think you can achieve those targets in? I think you're totally spot on. And actually, a lot of that will then be predicated on the individuals you bring along the journey into this new group who are going to have to deliver those services to achieve those outcomes. Is it the right home for them? I think that's fundamentally important as well.
Yeah, no, Shiv, we've spoken off camera about this, and, the dynamics at play from some of our competitors is one of my biggest frustrations over the last year or so, where that certainly is happening. The amount of times that I've spoken to vendors and acquirers as well, and it's the hardest conversation. It's human nature, right? When you hear a number, you're
Yeah.
going to have that number in your head, and we'll sit down, we'll meet them, we'll have a conversation, and we'll give them realistic expectations of what the market is saying. But unfortunately, they've been told that they might be able to achieve 2 times their revenue or a 10 times multiple on EBITDA, and you're having to realign their expectations. And I've seen it many a time where they'll go, James, well, I've been told by one of our competitors that I can get that. I'm going to go with them. And what happens is they do this dance for 6 to 12 months, and then come back to us and say, we didn't get any offers on the table. Um, and it's unfortunate because it's wasted 6 to 12 months of their business time when they could have got a deal done, um, and not had all the disruption as we know that happens, and distraction of running a business when you're having these conversations with potential suitors. But equally, we've had the same from buyers that we've spoken to, where they've spoken to some of our competitors, and
Yeah.
they've been told that they need to buy a business at 1.4 times or whatever it may well be. And that's, sometimes it's the really smaller practitioners that 250k, 400k, and they've been told they've got to buy for 1.4 or 1.5. And it's a difficult conversation that time. And I think what we're trying to say is to people is to have conversations with different people around the industry if you have to really get a true perspective on what the valuations are out there at the moment.
Yeah, I agree. I think the challenge you've got, I think, on your first example, particularly if you've had a firm who's sort of been doing this dance, as you say, for 6 to 12 months, inevitably these things can create a distraction to the core business. So the real kind of potential fallout you've got there is a business that isn't performing to its plan. And also the individual who potentially is trying to do its best by the business, but is also being distracted by a process. And then therefore the toll that can take personally, that's something that I don't think we talk enough about. And then the risk of, going back to market, and you may have then going back to the table with suitors who've thought, well, we were already speaking, last year, what's changed? And then unfortunately that can be used as a leveraging tactic, in terms of pricing negotiation. So I do think it's about discipline, right? Discipline in terms of actually if you want to go down a broker introduced route, who's the right partner that is giving you the same advice you'd be giving your clients. I think that's
Yes.
sometimes it's crazy how I think, as a profession, we don't necessarily apply the same values or same disciplines we try and instill in our clients on our own businesses. And I think if you're an acquirer going on your own journey, discipline in terms of, well, what is it? What's the strategic fit here for me? What's within my funding parameters? And because all these things carry risk, right? And I think it's just ensuring that you're not getting into this sort of bidding or pricing war over a business and then having to really wear that burden or risk after the event. So I think discipline just needs to kind of underpin it all.
Yeah, yeah. What I find bizarre with that whole dynamic as well is we're all busy, right? You're
Yeah.
busy, I'm busy. The vendors would be busy, so I just don't see what purpose it serves to have
No.
false expectations before you even have the conversation. So,
Yeah.
but anyway,
Agreed.
look, we've come that off, and I just wanted to go back to the models for a second there, and kind of come back to more of what's more akin to a TC model, where
Mhm.
you've got that minority interest for the vendors, or split equity, whatever, however you want to phrase it, and often that kind of looks like a 51% ownership by a TC group, for example, and there's other networks out there as well that offer a similar model, and then the 49% equity still sits with the incumbents at that point in time, whatever that may well look like. There may well be some changes, as we said, if there's some retirements there, but certainly for me, it goes back to that. Speaks to the people that still want to have ownership, but beyond that, it's more about the autonomy and independence, and that decision making still very much being at local level, whilst within the TC model. And I'll let you talk a little bit more about that. Uh, Having that infrastructure and centralized services support to take some of those heavy lifting or headaches away from you.
Definitely, and I think what we're doing more in our group as well is without compromising those fundamental principles of local autonomy and uncapped earnings capacity, earning out of the profits of your business, is demonstrating. Look, as now being part of a group with, we've got north of 50 offices now across the group. That'll be there'll be a number of kind of practices that have multiple offices, but fundamentally a captive market in which to lean on to share best practice and actually trying to provide data to all of our firms to demonstrate, look, this is how you compare to your peers. It's not intended to be a stick. It's more of a carrot to say, look, this is how you compare to your peers. Maybe that can elicit conversation so that you can understand what is it they're doing different to you that's driving better utilization or productivity among staff, driving higher margin capacity in the business, allowing them to achieve higher growth year on year than you are. And it could be that that firm may be using offshoring, that we have an offshoring business, or our firms can use their own outsourcing providers. It could be that they've done some acquisitions of their own. It could be that they're really driving and plugging in clients of theirs into other offices to provide other services to them that at a local level they're not able to provide. A combination of those things we've been able to demonstrate can really add value to a business and in turn add value to the earnings for the partners. So I think you've sort of, yes, you can be left on your own, but I do think there's loads of benefits you can have of being part of a group and having that kind of peer network to lean on to really try and get the benefits of really all the things other firms are doing that you don't necessarily have visibility of if you were a true independent practice. Outside of any peers you have in your own personal networks, it's very difficult to know exactly what other firms are doing, right? And or how truthful maybe your peers are about what they are doing in their own business. So I do think there's opportunity. It's certainly what we're instilling in our businesses is actually the opportunity to benefit from that and having that flexibility to adopt a range of initiatives that suits their business. Because it might be that, as a business, they're not geared up to using offshoring or outsourcing. If you're not, I think you'll know if you don't adopt those tools correctly, you don't really get the benefits that those resources
Absolutely.
should provide. It's not just about delivering work in a much quicker time scale than perhaps you can locally. It's making sure the quality of that work is commensurate to what a colleague of yours in your own team would be able to deliver. And it's not about reducing headcount. It's about increasing your capacity to do more of the same or value additive work to your clients. So sometimes that requires quite a significant behavioral shift or mindset shift. So it's just it's having that opportunity to be able to learn from others and their experiences and maybe the mistakes they've made to ensure that you in as the best possible position to assume those initiatives. So I do think there's definitely scope for both.
Yeah, no, absolutely. So, within as a TC model, what sort of part of the market do you feel that you find that you're speaking to the most, and the types of individuals and practices that you're having the most success with in terms of your setup and your offering?
Yeah, it's a really good question. What I would say is that I think the ideal fit again, mutually between us and a firm and vice versa, is probably that sort of practice where we've got multiple partners, maybe a few coming towards the end of their careers that want to realize capital. We can achieve a capital event like any other, but it's where you've got that kind of contingent of partners who are here for the longer term. We don't mandate how long that is, but I'm talking sort of 5+ years, and where they are perhaps a bit too bogged down with practice management, we can offer an infrastructure that far surpasses what they've invested in themselves, and being able to access those additional capabilities in our group that they're not able to provide their clients. I say that's where we probably play most successfully in, and that's where we see a really strong alignment of fit with other firms. For firms that actually do have that infrastructure in place, or maybe have a wider array of services they can offer clients than the other kind of firm I mentioned, then again, we do have success there where actually they're able to really tap into a captive market in our group, depending on where they're based geographically, to be able to cross sell some of their services or capabilities into other clients. So actually, it's a really kind of attractive route for growth as well. I think if you're a business that typically is quite ambitious, wants to grow through acquisition, we fund acquisitions on behalf of our practices. And so we're able to really unlock those opportunities. And the economics are just fundamentally different. When we fund that acquisition, that incumbent practice of ours benefits from the earnings from that acquisition, and that falls straight to the bottom line and into their pocket.
Yeah.
What we also are currently proving to be quite successful in as well is looking at that really kind of small independent practice that's all up to 1 million turnover, should we say, perhaps looking for that 100% exit. And what we're able to demonstrate is a lot of those firms have a reticence maybe to sell to the national kind of consolidators because of the concern that, now being part of a larger group, their clients aren't able to receive the same level of dedicated service they've benefited from to date. Perhaps the concern that fee rates will be kind of shot through the roof as a national firm tries to apply a national firm mindset to a local firm. What we're able to demonstrate is we've got the credibility and execution track record of a national firm, but actually those businesses are folding into our practices that apply and deliver those services at a local dedicated level with fee rates commensurate to the types of clients that they work with locally. Firms, and depending on where they are in the country, may be operating in the same sector, but they may warrant a different fee level than other firms in other parts of the country because of the cost base that they're all kind of experiencing locally. So that's where we play really strongly in as well from our side. I think a question I often get when we're talking to firms is what is our plans? What's our kind of medium to long term strategy? And over time, we expect to be changing our capital structure. That goes without saying, and that's really intended to facilitate providing us with more funding for growth, but not just growth in terms of bringing new firms into the group. We obviously want to be partnering with more like-minded firms, enhancing the depth and breadth of our capabilities. It's actually what more can we do with our existing practices. We made some investments around offshoring and outsourcing, robotics, AI. We want to carry on doing that, not to generate a return for us, but it's actually generating returns for the partners and ensuring that they're remaining competitive and doing what they're doing. It's perhaps thinking about bringing in other capabilities into our group that you don't necessarily find in a traditional accountancy practice, but which SMEs and owner-managed businesses will value and benefit from. So I think over time, it's really about just shoring up the business and ensuring we're constantly evolving and remaining competitive as a group, and so that partners are able to deliver the best possible service to their clients, and always considering options in terms of bringing in new firms into the group that share the same values and ethos to other firms in our group as well.
Yeah. No, I appreciate that, Shiv. And just going back to your model, and as we said, there's other networks that have got similar, that 51-49. When it comes to that model, we spoke about one of the dynamics that's a struggle at the moment being succession. With the incumbents holding that 49% still, sometimes when I have conversations, they worry about, okay, so how do I exit from that 49% whenever that time comes? In your experience, do you find that ever to be an issue? And if so, how have you overcome that? From my side, I tend to find that what happens is, because you've got that direct route into equity, and there's sometimes some help depending on what model you've got as well, it actually helps you attract the right people to the firm because they can see that direct route to equity. But if that doesn't work out, how do you guys overcome that in terms of TC Group?
Yeah, definitely. So the one thing I would say is, whilst we have a kind of a co-ownership, equity ownership model, 51%, 49%, the economic returns are very different to that. We have that ownership structure really to be able to present ourselves in the public domain as a single group and the benefits that can bring with it in terms of client acquisition or talent acquisition opportunities. But fundamentally, we get our return as a percentage of turnover. That's our way of being able to realize capital events for firms coming into the group. But in return for that, we provide that host of practice management infrastructure, which generate cost savings locally for those partners. So those partners basically remain owners of their P&L at a local level, but that P&L pre and post joining TC is fundamentally different. All those beyond kind of your staff, beyond your turnover, your staff costs and your establishment costs, in the main, everything else gets swapped out for the central service that we provide. So that synergies benefits those partners directly and offsets really our charge on turnover, which, as I say, is in return for providing those services, but also in return for that capital event. But basing our return on turnover than profits, shall we say, that means there's hopefully a stronger alignment of interest in terms of protecting autonomy. We're not having to get into discussions around managing cost base and overheads. Fundamentally, that's not really impacting our returns. So it's that 49% equity, whilst it on paper looks like a minority interest in the business, we give up all controlling interest rights to those 49% shareholders, and they have rights to all of the profits after that central charge and the cost savings, offsetting that in part. So really, it represents a majority equity stake in the business, and our job is to how we work with that practice to grow the business, and with that, therefore, grow those earnings. So for me, yes, we talked about ownership risk and people's attitudes towards that. I think that's fundamentally different in our environment because a lot of that risk we actually alleviate from that business at group level. And it just comes down to actually having that clear pathway of earnings growth as you continue to pour effort into that business and as that grows. And I think you're spot on. I think that has proven to be quite an attractive tool to attract talent because, as I say, you'll have individuals who are really ambitious, very good at what they do, want to progress, but they want to be in an environment where they're going to be rewarded in kind. And so the value of that equity that is being held by those partners that generates a level of earnings that's attractive will therefore have value to it. And so, we have had succession events in our environment, and we continue to see that happening going forwards. And it's really how do we facilitate that? Is it through bringing individuals from within the business up to that kind of equity level? Is it identifying individuals from the market, perhaps through an acquisition, or perhaps laterally hiring them from the market if that opportunity arises? In our model, it lends itself quite well to have practices operating not too far from each other. We're not fixated on having areas of exclusivity for businesses. Because I think we've recognized, look, accountancy firms can coexist not too far from each other. They've clearly coexisted today. They can carry on coexisting in our environment. The benefit is you can actually start collaborating if you want to. You can have real transparent discussions with each other. And perhaps over time, as we've seen in some cases, maybe consider an intergroup business combination if that's what suits the partners and if the sum of the parts is higher than the individual components. And that's a route, again, for that succession to be achieved as well.
Yeah, and that's one of the benefits again of being part of a group or a network with this 51-49 split, because if your succession plan does fail, at least you've got others within the group that you can have that conversation with, knowing that they've got similar models, similar ethos, and then that way could be another exit where it's just bought by another practice within the group or within the network.
Exactly.
Um,
Yeah.
Yeah, no, fantastic. Well, look, I think we've given everyone a real deep dive into various models and dynamics that are at play at the moment, and what practitioners are looking for. So hopefully, anyone that's been listening in can kind of gauge from that what might best suit them and speak to their needs and wants and requirements. Just wanted a future gaze for a second, Shiv. You kind of went into it a little bit earlier on, but in terms of activity in the market, where do you see it going for the rest of 2025 into 26 and maybe beyond as well?
So I think generally, from a market perspective, not so much TC, but from a market perspective, as we mentioned earlier on, there's been some primary exits that have already happened, some notable ones that are due to happen. I think that's going to really continue that kind of wave of activity for some of those firms who are exploring, for those consolidators, I should say, sorry, exploring their primary exits from one sponsor to the next. you'll probably see them perhaps be a bit more aggressive. I don't know if that's the right word, but certainly look at perhaps making more acquisitions in a certain time scale to really sort of shore up their investment case as part of their kind of exit strategy. And if you think about the multiple they're expecting to achieve, that's likely to drive a bit of pricing inflation in terms of their acquisitions, their willingness to perhaps pay a bit more than they would have otherwise. So I think that's going to naturally drive up activity and appetite on both sides of the coin, seller and buyer. I do think, though, there's going to be a time when this will start plateauing because, as I say, there's going to inevitably going to be fallout from some of these transitions and transactions. And there may be some that aren't able to achieve the outcomes that we've seen or are purported to happen to date. Perhaps they don't happen at all for a variety of reasons. And I think that will then create uncertainty and risk in people's minds as to whether or not actually is it right for my business to be joining a group that's on, is this the right group for me? Basically, if they're not able to achieve the outcomes that they've sort of set out to achieve. But I do think there's going to be this underlying undercurrent that's going to drive consolidation. I think the P model has very much disrupted the sector. It's provided a lot of opportunity. I think it has made us as a profession perhaps more agile and competitive if done the right way. And whilst I do think you will have independents that will thrive and continue to thrive, I think there'll be others that are unable to, aren't able to thrive because of the, where they are in their kind of life cycle and the partners in that business and where they are in their personal circumstances. So I do think there's still going to be genuine, valid reasons to explore their options as well. I mean, we're seeing US equity coming into the market. I think we're going to see more of that. I think time will only tell what impact that's going to have. It could very much upend everything I've just said now, by the way, and it could see volumes even higher next year than we're probably expecting this year. It's really difficult. I think what we can say is I don't think anyone expected what we've seen the last 24 months, 36 or 48 months ago. I don't think anybody would have expected that. So perhaps expect the unexpected is the message. Who knows?
Yeah, no, absolutely. And you're right. I know we've referenced throughout this when we talk about different models, private equity, private equity, private equity. But actually, there's a lot of really good independents out there that are also doing similar models as the private equity, just in their own way. And I was speaking to someone the other day about, looking at the market as a whole. And obviously, a lot of the larger mid-market firms have now been bought up and joined one of the consolidators. So they were talking about this large black hole or void in that mid-market sector. And I think for independent firms that do stay in their lane, they've got a very clear narrative of who they are and what they stand for. They also equally, because of what's going on in the market, have got so much opportunity for them to acquire or merge with other firms as well and fill that void, if you like, as they grow. And I guess, as we were talking about the expertise or that infrastructure at top level, they're going to have to make a decision at what point in their journey do they make that investment into non-fee earners, which we know for accountants is a tough decision for them to make.
Yeah, I agree. I mean, there are firms today, who are independent of a size where they've had to make those investments or certainly are making those investments. And I think if you've got a clear strategic plan as you are as a business on your own 2 feet, and you make those decisions with that plan in mind and you have the discipline to see that plan out, then I think I agree. You can't see why those sorts of firms can't thrive. And I think the opportunity to do so will only increase if, as you say, there's this sort of black hole that they all void that they can fill. So for me, I think it's really exciting to know that actually for even individuals looking to come into the profession, younger generations, there's so much optionality, I think, for them. It's not one size fits all. I think, you've got so much really to consider for yourself, which I think can only be a good thing as well.
Yeah. And that's a really nice way to finish the conversation, Shiv. But, I think, as we said, as I opened up the conversation, right now in the market, it is probably one of the most exciting times for people like ourselves in the M&A space because of the opportunities out there, but also all these different types of businesses, the different shapes and sizes for vendors or people that are looking at their options. The opportunities and the different models are out there, and the more commercial approach rather than the traditional approach to M&A is really enlightening for me, and it's been great to get involved in those conversations because I feel like people like you and I can add more value to those conversations as well. Then because you have to think about it, you have to tailor it for the individual needs of the individuals that you're speaking to.
Yeah, I agreed. Yeah.
Yeah. Lovely. Well, look, Shiv, I really, really appreciate your time. I hope it's been an interesting conversation for me, and I hope the people listening in have found it just as interesting, and gives them a lot of food for thought. But yeah, also open up conversation for them internally, maybe with their partners and their leadership team.
Yeah, definitely. No, thanks as well for giving me the time as well. It's been great.
No, appreciate your time, Shiv. Thank you very much.
All right, take care. Thanks.